Alright, so for this video I wanted to go over the IRS's hobby loss rules and how many U.S. taxpayers every year are subjecting themselves to unnecessary increased audit risk because you have Schedule C losses on your 1040. So I've got two slides in front of us with some information, fact pattern, and then I have some sample tax returns that I want to go through to illustrate how Schedule C reporting versus Schedule E reporting can actually help reduce your chance of audit. Okay, so let's start on this slide and walk through some of the rules and then some examples. So starting at the top here, if you start a new business, right, and so let's say it's your side business, so you have a full-time job and you want to start a side hustle. If you're losing money in those early years, those are losses that you're eligible to deduct, but you need to be mindful of the hobby loss rules. So the IRS considers an activity to be a hobby if it's not engaged in with a for-profit motive. So what they're saying here is that if you have an activity and you quote, let's say call it a business, but you really have no intention of earning a profit, you're just constantly generating losses, and you're generating those losses and using them to offset your other income, the IRS is going to deem that to be a hobby and they're going to disallow the expenses. And why is that? Because when you have a hobby, you have to report the income, right? But you are only allowed to deduct expenses to the extent you have income. So if you have a hobby that generates $5,000 a year in income, you can only deduct expenses up to $5,000. You cannot deduct $8,000 worth of expenses to generate a $3,000 loss. Okay, so why is the IRS targeting these Schedule C losses? Well, Schedule C is used to report business activity from a trade or business for either a sole proprietorship, so you have no legal entity set up, right? So if you decide to just go down to the street corner and open a lemonade stand and start selling lemonade, you have no legal entity set up. You're still in business, right? You open a business, but you have no legal entity. You report everything on Schedule C. Or you do have a legal entity. You set up an LLC where you're the single member, the 100% owner, and it's a disregarded entity for federal tax purposes. So single member LLCs that are disregarded entities report their activity on a Schedule C. Now the IRS did this study in 2007, and what they were doing was they were reviewing Form 1040s where a taxpayer had $100,000 of income collectively from other sources, so let's say a W-2 job, and they also had Schedule C losses 4 years in a row, and they were specifically targeting them for audit. And why are they doing that? Because the Schedule C losses were flowing through and offsetting this income from other sources, which ultimately lowered their taxable income. They paid less tax. So for example, John, let's say he's an engineer, he makes $125K a year, has some investment income, and he has a side hustle business running an e-commerce store through a single member LLC, so it goes on to Schedule C. And the losses every year were offsetting his W-2 income. So he was paying less federal income taxes because he's claiming these losses. John is an example of a person that is at high risk of audit because of this situation. So if you're a taxpayer and you've got Schedule C losses, even if it's 1 or 2 years, in my opinion, and based on what we see in practice, you are at a very heightened risk for IRS audit. That is a huge red flag. So what are some ways to reduce your audit exposure here? Well, you've got a couple of options. The first and foremost that you have to do in order to make this work is get your losses off of your Schedule C, right? So we cannot be reporting losses on Schedule C, otherwise we're in the same place we were before. So how do you do that? Well, the first thing you've got to do is form an LLC or other type of legal entity here. So the LLC has to be taxed as either an S Corp or a partnership. And here's why. The S corporations and partnerships file their own tax return. So an S Corp files an 1120S, partnerships file a Form 1065, the owners get a K1. And if losses are reported on that K1, the losses flow through to the Form 1040 and are reported on Schedule E. They are not reported on Schedule C of your Form 1040. So if we look at an example here, John Doe, this is his Form 1040. He's got a Schedule C here. Here's his LLC, John Doe LLC. He's got his income, he's got his expenses, and then down here we've got a loss of $3,436. Now this loss, let's say this is not a hobby. This is a legitimate business for John, but even though it's a legit business, he's still subject to audit risk because he's showing a loss here. The loss is ultimately going to flow up to Schedule 1, and there it is, reported on line 3, 3,436. Now, what if instead John made an S Corp election for this LLC? If the LLC makes an S Corp election, he's no longer doing any reporting here on Schedule C. Instead, now we're reporting on 1120S and then ultimately Schedule E for John. So once the S Corp return is filed, John gets a K1. Assuming all the numbers are the same, this is how the reporting looks like now. On Schedule E, page 2, part 2, we have John Doe LLC, S Corp, and then here we have the non-passive loss that's being reported minus 3,436. It's the same numbers, right? Remember, the LLC has still got the same revenue, the same expenses. Nothing changes there. It's just the way it's being reported through your tax returns. So we've got 3,436 now, flows up here. Notice how instead it's not on line 3, right? We do not have a Schedule C here. We report everything on Schedule E and it goes through to line 5. Again, it's the same loss, right? So the activity, for the most part, it's all the same. It's just a different reporting mechanism. But by doing it this way, the IRS is significantly less likely to look at the losses on your return if they're flowing through from an S Corp or a partnership versus a Schedule C. Okay, so how does this help? Well, like I said, the losses remain the same, right? So the LLC is still reporting the same income expenses, but given that the losses are on Schedule E, subject to much less scrutiny. The other little kind of qualitative element here is by setting up a separate legal entity and having it as a regarded entity filing its own tax return, it's one factor of many that kind of leans towards this idea that it's not a hobby, it's more of a legitimate business with a for-profit motive, right? And that's because if you've got a separate entity, you've got separate bank accounts, you've got a separate EIN, a tax ID number, separate tax return filings, right? You're reporting your P&L, and on the Form 1120S and 1065s, you're reporting a balance sheet, right? If you look at Schedule C, there's no requirement to report balance sheet information. And that's actually, believe it or not, quite significant, because if you have a balance sheet being reported on your 1065 or your 1120S, it suggests that you're keeping internal financial statements, right? You've got a full set of financial statements. You got P&L, you got balance sheet, you got cash flows. Versus Schedule C filers really only need a profit and loss statement, right? The other element here is 1120Ss and 1065s. It's a bigger tax return. It asks more questions. It requires more disclosures. And so for those reasons, it requires you to kind of examine your business a little more versus a Schedule C sole proprietor filer. They just fill out Schedule C. I mean, if you look at the Schedule C, there's hardly any information reported here, right? It's the name of the company and address, and then you just have the income and expense information. Versus if you were to look at a 1120S or a 1065, it's pages and pages of information that needs to be disclosed, okay? So let's talk about the audit risk here. Well, there's not a lot of current data. The IRS publishes this data in a lag. But if we look at the audit risk for 1120S and 1065 filings, significantly lower, right? So for individuals in 2017, there was a 1 in 161 chance of being audited. In 2017, 1 in 358 for 1120S filings. And then 1065 filings was 1 in 260. So by moving your business activity off Schedule C and putting it through an S Corp or a partnership, you're already immediately lowering the chance that you're going to be audited for that activity. Okay, so it provides you a lot of benefit. And I left a line item off here, but trusts, Form 1041s is even much lower. I think it's maybe 1 in 1,000 or 1 in 900 some odd. So so 1120S filings, 1065 filings, trust returns, much less susceptible to audit than if you have everything being reported directly on your 1040. Okay, so that covers it. I hope that was helpful. If you have any questions, leave me a comment below, and I look forward to seeing you again on the next video. Thank you.